Very good morning. Coming to this slide, how are returns made in mutual fund, or what are the role of mutual fund, and how these returns are made whenever public invests at large. So, a mutual fund investment is a basket of securities. As the price of the security changes, like for stocks and some bonds, a fund earns the interest on bonds it holds. It has a value of its change. So returns are made based on the market, based on the expectation, like what we call gain in stock, bond prices and value higher and vice versa. So fund value moves up, your investment value also rises. So how it being valued and how these returns are made in form of mutual fund, a public or the investor investing in mutual fund, and how it being valued and how this return is expected. So if you see this slide, it also says that it is a pool of basket. I can tell you, investing in one particular investment pattern, let you invest in different types of a pool, or diversifying multiple diversification of different investment, where one have a profit, one more less profit, one more no profit. So at least somewhere you have a balancing with the average fund, and you don't aware that either profit or loss. You are balancing with the profit and loss. There is no profit also, no loss. Why? Because you invested in profitable also, loss making also, but it is somewhat it is balancing. So instead of investing in one bucket, you invest in multiple bucket where you get a return. So one might be having profit, one may not be having average profit, one may be having with the 0% profit. So it is diversified in nature. So here what you can study under this slides, like how they are return expectation according to the investor and how it is made in form of profitable. So gain in stock, bond prices and value higher prices. So a practical knowledge will be clearly understood in future days. So future classes will be some of the practical classes, offline classes will be engaged here. So when it's come for mutual fund, investment in particular basket, yielding return with the same basket or without return, loss making. So instead of investing in one particular basket, you go for multiplication of your investment in different patterns. So number one, when you sell your fund, in this case you earn capital gain. Whenever you make a sale, you get some kind of a capital gain. Right, cash comes in. So capital gain is the profit on your investment when you sell your mutual fund units. It is a difference between the market value of your mutual fund unit at the time of sale and the cost of such units. It is very clear. Normally, it is not only mutual fund, any asset what you buy and sell. If you sell for more than the cost price, 100% is profitable. Lesser than the cost, it is a loss. So here it is said that a fund which has been sold under different market value of the mutual fund unit at the time of sale and the cost, as the cost attached when you bought it. Right? It's so simple. You bought for 10 rupee and today you're selling for 20 rupees. So 10 rupees is a profit. So cost attached and the market value is classified here. The gain comes in from the appreciation of your fund value. Selling value is lower than your investment cost. You made a capital loss. So this is what I said. Capital gain and capital loss. Your cost is more than the profit, right? So cost itself shows an expenses, so you might be losing that money. So here under capital gain, gain in stock or bond prices has a higher valuation, vice versa for everything. If it is less, you might be losing under capital gain, right, or capital loss. When you earn dividends on your fund, this happens when mutual fund declares dividend out of accumulated profit is made, right? And this accumulated profit can be in terms of securities sold or for profit, interest earned on investment, dividend earned on stocks. All these are classified into different valuations. So when you earn dividend on your fund, when 100% market is there, when 100% market give a much result of return, 100% when market yields some kind of a classification or return, all this being evaluated in systematic. So evaluation method in form of return dividend. So that's what I said. When it's come for stocks, investing in the equities, Where profit is there, then you get a return. When there is a loss, you don't get a return. But when it's come for SIP plan, there is a systematic investment plan where 99% of the funds always yield return with high level of a profit, and interest on the investment, dividend on the stocks are very much clear when it's come for dividend declaration of the fund. And the next slide is all about third one as a dividend versus growth option. Right. Either you have a dividend, or you have a growth. So both is needed. Dividend for today and growth for tomorrow. That's why we talks about in investment yielding return today, return tomorrow. Sometime return or dividend can postpone also. So especially the company, new startup company, initially they want a capital, so even they come with the profit, sometime dividend declaration they might force the investor to declare the dividend in the future days. So why? Because under capital and the growth, they want this dividend can be postponed for the future date, just to go for diversifying or the growth of their company. They want to postpone the dividend. So in the growth option of mutual fund scheme, all profits made by fund are ploughed by back into the scheme, right? The dividend option of a mutual fund scheme, profits made by the funds are distributed to the unit holder from time to time, and this dividend deducted from net asset value given back to you. Therefore dividend in the mutual fund is simply your own investment coming back to you and not additional return made. So sometime growth versus dividend, you should see whether which is more profitable in future dividend expectation or current dividend declaration. So growth options of mutual fund scheme, all profits made by fund back to their scheme divided between what, with the mutual fund scheme dividend declaration what, all these are classified based on the classification. So they just see that how investment objective of mutual funds are made and investment expectations can be fulfilled. Then coming to the third slide, why should you invest in a mutual fund? This is one of the questions. As a common man, or as an investor, as a public at large, as a saving of your income, where to invest, and why this investment in the mutual fund. One of the idea about the investing in mutual fund, they also call it a diversification. One of the advantage of investing in mutual fund, a potent way of reducing risk, ensuring the portfolio deliver across market cycle. Here one word they said, reducing risk. Mutual fund always have a systematic return on the fund which is being invested. It might be having a slow growth, not like a market, day to day they getting fluctuated, but mutual fund always focus on the future protection, where they have potent of diversification of these funds and yielding of some return in the future day, and they might be seeing the reducing of this type of risk and ensuring the portfolio delivers across the market cycle. So when you invest in different stocks in different sector, you are spreading your investment out, since each sector stock behave differently, you have different drivers, but it's hard to do so when investing direct in stocks, since it is hard to buy a large variety of stocks. So if I go for classification, you might see so many people buy different types of funds in the market. Some might go for long term, some might for medium mid caps, right? Some are under LIC schemes, some are under government schemes, government bonds, government security, or post office schemes. Today post office schemes also yield some kind of a return which is fixed in nature, less riskier, or because they are the public sectors, so less riskier compared to the rest of the investment sector. So people prefer to invest in such kind of a fund where it will yield a good return, rather than I can tell them, rather than expecting more return, it will yield good return with the less risk. So this is how it shows. like how return can be done and how expectation of this return can be fulfilled. So this is how it go for classification of different source of revenue. So one of the mutual fund investment, and why should you invest in mutual fund, what is the classification. So diversification is one of the area, and many of the time diversification of funds will arises whenever it is required. Probability of diversification will come whenever market is not picking in particular fund. Take example, if I invested HDFC before 10 years, take example 2010 I just started investing in HDFC mutual fund, one of the mutual fund, one of the scheme mutual fund, and I can give a real example about how this investment funds have been diversified. End of the day, mutual fund also, the fund raised by through mutual fund also invest in the stock market or some kind of a fixed income which will generate more income than the cost of the funds which has been returned in the name of interest to the investor. So even the mutual fund manager invests in different revenue which is generated from the public at large. That's a pool of money from the public. So though they invest in stock market, invest in LIC, invest in many other firm, and that will yield more income rather than the return what is expected by the fund holder. So here one of the advantage, like before 10 years you expected of a return because the market was in the slow growth. After 2020 to 2024, after COVID especially, you might be seen market has gone very high. So the fund manager has to think that whether what type of a systematic plan has to be kept in mind before investing. Now how long this investment can be made and how they can be reduce the risk, ensuring the portfolio delivering of a market cycle across the market calculation. So this is how it goes. So this is about the why investments in the mutual fund, especially it is a diversification. One of the advantages is the diversification of your fund, and it will yield a fixed rate of return. Then next, why it's a professional management. A primary advantage of mutual fund is not having a pick stocks and manage investment yourself. It requires both time and skill. A professional investment manager takes care of all the using careful research and skillful trading. A mutual fund is an inexpensive way of small investor to get into full-time manager to make monitor investment. Most private non-institutional money manager deal only with the high net worth individual. And if you see in the stock market, you need a minimum balance to invest. But in the mutual fund, whatever balance you have, you can invest in starting price from the 500 with a small segmented portfolio, and you expect it in the long run. And I can give an example. I have invested in 2009 in HDFC, one of the mutual fund scheme. I was spending money of 200 to 500 rupees, especially 500 was the band price, the final price, and invested for more than 12 to 13 years. And I can see the return, it is 3 to 4 times higher than what I've been invested. So it depends on the market price also. The professional management, a professionalism by the fund manager, he will look into the managing of investment of the public very systematically, time bounded and skillfully, and there is a professionalism of investment manager to take care of this research and skillful trading when it's come for investing in different categories. So it is going to be classified institutional, most private, non-institutional money manager deal with high net worth individuals. Sometimes you might be seen here. Private sector always classify high net worth individual only. They classify, they categorize with the highly qualified, with the highly non-institutional money managers. So private is in more focus to be invested rather than any kind of other professional management. Then variety and freedom of choice. You have a wide variety of mutual fund types to choose. Like there are equity, debt, gold funds, beside of all these funds, invest in combination of this. Each fund is managed in different way. There are multiple strategy. Fund manager may focus on the value of investing, growth investing. Then developed market, emerging market, among others life cycles. So all these are very classified in a different way, and this is how they are into different classification where variety, you have a variety form of way of getting into developed market, emerging market among the people. Freedom of choice, that is important, which equity you can choose or which funds you can choose. If there is no option left out, then 100% there's a win-win situation where you might be choosing of one particular one, you might go wrong also. So instead of that, you have a pool where you divide into multiple group. Based on the multiple group, you just go for investing in different point of investment plan. So there are schemes, there are investment plan where you can encourage to get invested. And this is what I said about professional management and the variety of freedom of choice is to be taken into consideration. So here example is given about variety of freedom of choice here. One is equity, debt, gold funds, right? So in mutual fund is a combination. Beside fund that invest in the combination of this. So you have a freedom of variety will be, you might be choosing the equity, it might be in form of debt or debenture, gold funds, right? But when it's come for equity, there is a difference. Like in equity, uh, you invest in equity, but there is no guarantee of return. Might be guarantee of return in the long term, but the short term, if profit is there, then only guarantee. If no profit, you are suffering with the loss. But when it's come for debt and gold fund especially with the market, present market rate, you will get a price. But when it's come for debt, it will yield one fixed rate of income. That's why they are safer than other any type of revenue where less risk is involved, less return also expected, but reward somewhat stagnated based on the market valuation. And coming to this slide, the last slide here, they are very much a transparency. Mutual funds are regulated by SEBI. Mutual funds are very much transparency. Investment in mutual funds are very much transparent. Why? Because they are monitored, regulated by Security Exchange Board of India. SEBI has been adopted the protecting investor interest in mutual funds, ensuring the best practice of AMC, right? So mutual fund companies are protected, and over the years SEBI has brought into continuous bring regulation to prevent AMC mutual fund company from taking undue risk, overcharging investor, making false claim. Mutual fund also score a disclosure. Mutual fund need to disclose its all portfolio and asset size every month, its expense ratio, net asset value every day, all the times an investor aware of their money it's being invested. So when we talk about transparency, SEBI will monitor about mutual fund, their transaction of the company, company turnover, company scorecards, their fund asset management, portfolio management, portfolio manager being classified, the size of every month, how much money is spent on what ratio, net asset value of the company, based on investor awareness among the money those who invested, whether investors should know that where they invested. So SEBI will give a guidelines for every company to follow, to be regulated under Securities Exchange Board of India to ensure the practice under mutual fund companies. So then you have a ease of investment. Mutual fund always is most attractive. Why? Because there is a less risk. Investing in mutual funds spares the investor of the numerous commission charges need to create a diversified portfolio and large transaction fees. That is also there. When you diversify the portfolio, there is the transaction cost too. So mutual fund allow an investor to build wealth. Investment denomination as a small rupee 500 can be made. So I said starting price is 500 rupees. Starting price you can invest as a base price from 500. In this way, even small investor can slowly build up their wealth and still own well diversified portfolio. Mutual funds allow investors to set a periodic investment such as every month, every week, They also allow investor withdraw per based on what whenever it is required for every customer, the investor, when they require, they can take their money or pull back their money based on the requirement. So here, ease of investing in mutual funds paid the investor about commission charges operated and investment kind of denominator standing with the 500 rupees is made and wealth can be created. This, as in a student, you can start investing mutual fund just from 500 rupees. Just from 500 rupees every month, every quarterly, half yearly, or for annually. It depends. You can multiply your investment portfolio also. You can diversify this investment portfolio also. So I'll stop here. Remaining we'll see in the next class.